Okay, this is chapter 9 from the Phillips 7e textbook, working some of the exercises in there. So I have the ebook up and I'm on page 425 in your textbook. We're going to start with exercise M9-4. We're just going to do M9-4 and M9-5 because they actually are the same data set. It's just two different methods they're using. And so for M9-4, a little bit bigger with it. It says a machine that costs $400,000 has an estimated residual value of $40,000 and an estimated useful life of 4 years. Company uses straight line depreciation. They want you to calculate the book value at the end of year 3. So with straight line, that's not a big problem because it's the same depreciation every year. So once you get it calculated, you just multiply by 3 to see what the depreciation, accumulated depreciation would be. So we're just going to take it step by step. We have the original cost. Let me just get a little black ink on it. $400,000 cost with a $40,000 salvage means $360,000 depreciable. The salvage and residual mean the same thing. So 360,000, they said it had a 4-year life. So you could think of it as taking the 360,000 and dividing it by 4. That would give you the straight line depreciation. Or you could think of it as multiplying it by the straight line rate. In this case, the straight line rate is, you always calculate the straight line rate as 1 divided by the life. So in this case, the straight line rate is 1/4, or the equivalent percentage would be 25%. So for this textbook this solution actually has used the 1/4 as their way. They could have just as easily said multiply it by 25%, or they could have just divided it by 4. It's all the same. It's just different formats that you could put it in. So $90,000 is depreciation. So each of the years, starting from the first year, they would have debited depreciation expense and credited accumulated depreciation by this $90,000. So at the end of the 3rd year, they would have done that 3 times. So their accumulated depreciation would be at $270. Now, if you're nervous at all about whether you're calculating the numbers right, you would do the calculation and then you just make a T account for the accumulated depreciation to see how much have they accumulated at that point. But this is the same every year. It's pretty safe to say accumulated is $270. And so the net book value at that point would be the original cost minus the accumulated depreciation. Now, when you're doing net book value, you don't take into account any salvage because salvage doesn't show up on your balance sheet at all or in your books, your T accounts or general ledger. It's only a calculation tool to help you not depreciate the asset too much. You're estimating what it's going to be worth when you're completing your use of it. And so it's just a reserve that you're thinking of to keep. So you're going to, well, at the time you fully depreciate it, you want the salvage value to equal the net book value. But that salvage does not come into play when you're calculating net book value. It's just a notation you're making to say, hey, make sure you reserve this much of the net book value and don't depreciate it all the way. So if you had depreciated $270,000, that's what your accumulated balance is, then your net book value would be $130. Net book value every time is the original cost minus the accumulated depreciation. So $400,000 minus $270 gets you back to the $130,000 net book value. And it's also called book value, but it's just a little cleaner what it is when you say net book value. You're kind of indicating when you say the word net that it's talking about an asset minus its contra. Okay. Or if it's on the liability side, a liability minus its contra would be the net book value of the liability. Okay, so that is straight line. Now the M9-5 is asking you to do the same kind of thing, but it's just asking you to calculate a units of production depreciation instead. So this one says the machine cost $400,000, had estimated residual of $40,000 and an estimated useful life of 20,000 machine hours. So as soon as you see that they give you a useful life based on some quantity, then you can assume it's going to be units of production kind of problem. So we're going to take that same 360, the cost, for depreciation. That's our depreciable cost, even though the residual, as I said, is not in the bookkeeping. It is in our calculation notation. So we take the 400,000 minus the 40 that we're reserving for residual or salvage, and that leaves us with 360 that we're going to depreciate. So the assets cost was 400. That's what's recorded on the books. So we got 400. We're going to use that, and we're going to subtract from that the accumulated depreciation that's at the end of year 3. So what the information they gave you to calculate your depreciation is 20,000 is the machine hours they're expecting the machine to be able to last for. So they'll take 360,000 and divide it by that 20,000 hours that we're expecting it to be able to make it. That's going to bring us to 360 divided by 20,000. It's going to bring us to $18 per machine hour that we're going to charge out as depreciation. So the problem has to give you all these figures in order to be able to calculate it. It's got to tell you then the years that you're depreciating, how many hours were actually run on this machine. So it does. It says in the company uses units of production depreciation and ran the machine for 3,000 hours in year 1, 8,000 hours in year 2, and 6,000 hours in year 3. So we're just going to calculate the depreciation based on that. And so if you multiply $18 times each of these years, you could just make a T account and enter the amount of depreciation, accumulated depreciation that would have been posted to it each of those years, or you could just add these 3-hour amounts together, 3,000 plus 8,000 plus 6,000, which would put you at 11 and 6, 17,000 hours times $18, and that would still bring you to the accumulated depreciation number. And you can do it both ways if you wanted to see if it's going to work, and you'll see that it does. So the total accumulated that's been depreciated for those 3 years is 306,000. So now it's a piece of cake to get the book value, because book value is nothing but the cost, 400,000 minus the accumulated depreciation. And so that brings us to a book value of $94,000 under the units of production method. They have an explanation of how they did it. So let's go ahead and reveal it. We'll see if you like that. You also could have come to accumulated depreciation on this one by 360 times, and they just did the way I did it out loud. Okay, so that's exactly the same way. But so you could use your T account and do each year's depreciation entry that would have been made, or you can just combine them and say it's used up this much of it because it's used this many hours over the 3-year period. Okay, so that's M9.4 and M9.5. And then the next one that we have is in the exercise section. Let me go back out of the mini exercises and go to the exercises then. This one is number 916. It's on page 432, E916. This one says Tord Company bought a machine for $65,000 cash. The estimated useful life was 5 years. The estimated residual was 5,000, and they want you to assume the estimated useful life in productive units is 150,000. So units actually produced were in year 1 and 2, 40,000 and 45,000. So you know when they give you those units, they're going to ask you to calculate based on units of production. So we'll see what the requirement asks, but you know that's going to be there, or they wouldn't be giving you those units. Requirement 1, determine the appropriate amount to complete the following schedule. They're asking you to calculate straight line, units of production, and double declining balance for year 1 and 2. Calculate the depreciation expense, and then calculate the book value at the end of the year. And then it's asking you a couple of questions, number 2 and 3, which I'm not necessarily worried about. So I'm just going to calculate the 3 kinds of depreciation. That's what I'm trying to get out of this problem. So let's see. If I can make this a little bit bigger, it'd be easier. So let me try that. All right. So go back to the data set. We've got $65,000 purchase with a residual of 5. So for purposes of the straight line and the units of production method, we're going to use a depreciable cost of $60,000, which is just the 65,000 minus the 5. Now for double declining balance, we do not use that reduced depreciable amount. We use the full net book value every time we start to make the calculation. So let's do our calc for straight line. We're going to take $60,000 divided by the number of years. It was an estimated useful life of 5 years. So you could take 60,000 divided by 5, and that will give you 12,000 a year. Or you could take 60,000 times 1/5, which is the same exact thing. That would give you 12,000 a year. Or you could say, well, what is 1/5? It's 20%. So using the straight line rate, 20% or 1/5 would be just as easy. So 12,000 is the same result both ways. So 12,000 is your depreciation no matter how you slice it. And so if you look at book value, it's going to be the original cost of 65,000 minus the accumulated at that point. So for at the end of year 1, the book value is 65,000 minus 12, 53,000. And then if you depreciate another 12,000, the book value at the end of year 2 is 65,000 minus 24,000, which brings you to 41,000 net book value. So that's straight line. Very straightforward. Okay, then units of production. Each time we're going to take this, the amount per, let's calculate it first. We take the depreciable cost of $60,000, we divide it by the estimated productive units. So 65, I'm gonna write this up here. 65,000 minus the 5,000 salvage or residual brings us to 60,000 divided by 150,000 productive units. And that's going to bring us to they put the rate in here. So I'm just going to figure out where I put my calculator. I bet I got a calculator on my phone. Okay. 60,000 depreciable divided by 150,000 productive units we're expecting. So it looks like it's 40 cents. They didn't actually work it that way, which I think they should have. So I'm going to do it that way. And then we can do it their way as well, of course. So what we've got is they took it and said 60,000, which is the depreciable cost, times 40,000 divided by 150,000, which is the same thing that we're going to get when we do it our way, my way, 16,000. So at 40 cents a piece, you could still do it my way by saying in year, the cost, the depreciation cost per productive unit is 40 cents. So I'd say 0.4 times the production for year 1, which was 40,000. And it would still equal that same 16,000. Right? That makes sense? All right. So 16,000, either way you calculate it, it's the same effect. And then if 40 cents is the number that we can charge for depreciation expense for per unit, the second year is 45,000. So 45,000 times 40 cents. I'm just doing mine first. $18,000 is what I think it is. So what did they have? They took the 60,000 they really are doing the same thing. They just didn't come to a per hour rate like I did. 60,000 times 45,000 productive hours this period compared to 150 productive hours expected for the whole period. So they still are going to come up to my same $18,000. It's just two different ways of tackling it. So that's units of production. So we have 16,000 for the first year and 18,000 for the second. You just not want to let me reveal it. Hang on a moment. Okay, so the book value at the end of the year would be the original 65,000 minus 16,000 in year one, because that's how much accumulated balance would be. It would have 16,000 in it. 65 minus 16 gives you a book value at the end of year one at 49,000. Then at the end of year two, after another 18,000 was added to the accumulated depreciation, we would have book value of, what is that, 31,000? Yes. Okay, so that's the first two methods, and that you should be able to do that on a test without any hesitations. You have to study it until that really just comes naturally. Those all three methods. So the third method is the double declining balance. And on this one, let me see how they did it. And then I may have to come back and do it a different way too. Let me get me a new page here so I can see it together. Okay. All right, so I'm going to reveal theirs for you. What I would do is take the whole 65,000 and multiply it by 40%, which is twice the straight line rate, or multiply it by 2/5. Same thing, twice the straight line rate. And that would be my depreciation for year one. Let's see what they did. They multiplied it by 2/5. Yes, they did. So they got 26,000. So that was their first year depreciation, which I totally agree with them on that. Then the second year, I have to have the net book value. The net book value at the end of year one was 65 minus 26,000. So the net book value, might as well do it here, right? The net book value at the end of year one is 39,000. So that's what I'm going to base my second year's calculation on. I'm going to say 39,000 times 40%. So they're just calculating again the net book value right there, times 2/5, which is the same as 40%. So the depreciation for year two is 15,600. Their way and my way, same deal. So the net book value at the end of year one had been 39,000 under this method. And if we reduce the net book value further for the extra that's been added to the accumulated depreciation account, we wind up with a net book value at the end of year two, 23,400. So this is just the way it works. The only thing that would trip you if you were doing this, if you listen to this and make sure you understand, you go through the textbook, go through the Learn Smart, you do your homework. The only thing that's going to trip you if you totally understand what we're doing here is you might try to put the salvage into the calculation of the net book value. Net book value is always the cost minus accumulated depreciation. So if you had T accounts or a ledger where you could see the balance, the end balance of each of these, then you would know what number you're working with for book value. Book value is what's posted to the T account and the balance sheet, okay? So you take the cost of the asset minus the cost of the depreciation, and that is the net book value. That is the book value also. That's the same thing. Okay, that's good. Now we're going to do one more exercise. This one's in the problem B-set problems. Let me go grab it. PB92. It is on page 436. So this one, it says, during the current year, Rayon Corporation disposed of two different assets. On January 1st, prior to their disposal, the accounts reflected the following. Machine A had a cost of $60,000, residual value of 11, estimated life of 7, and accumulated depreciation of $48,000. Oh, being stretched over a 4-year period. Then machine B had a cost of 14.2, a residual of 19.25, an estimated life of 5 years, and a accumulated depreciation of 7,365. So what they're doing is they're telling you not just what's on the balance sheet, but what is also in their note sheet about how they're calculating depreciation. Because the only pieces that are on their, can't do it that way, sorry. The only pieces that are in the balance sheet are the cost figures. Let's go ahead and highlight the ones that are in the balance sheet. Cost for each asset, and accumulated depreciation for each asset. So I could look at their balance sheet and pull these, but unless I looked at notes to the financial statement or somewhere like that, I might not be able to find the residual value that they're using in their calculations or the estimated life. But in the problem sets we're given, they're always going to state these things because you can't calculate depreciation without them, and you can't calculate gain or loss without seeing some of these things, okay? Well, you could calculate gain or loss without seeing them. All right, so what are the directives that they want? First, they said another fact set is the machines were disposed of in the following ways. Machine A was sold on January 2nd for $33,500 in cash, and machine B on January 2nd was scrapped with 0 proceeds, 0 cost of removal. So they're asking us to make the journal entry first for machine A and then for machine B. Piece of cake, we can do this. So machine A, they're asking for the depreciation. It doesn't have any because it was on the 2nd of January, before the 15th. So usually if it gets into the first half of the month, of the first month, then it's not depreciated any further for the year of disposition. To record the disposition, as you know, when we're trying to dispose of an asset, if you listen to the lecture notes that I had on chapter 9, you've seen that when we dispose of an asset, we have to clear the accounts for the asset and for the accumulated. So since the asset account is a debit balance, we have to clear it when we dispose of it with a credit. And since the accumulated depreciation is a credit balance, we have to clear it with a debit, sort of like when you're doing a closing entry. You're trying to wipe out its balance and bring it to 0 because that asset's not going to be with you anymore. So we're going to credit the asset account. We're going to debit the accumulated account. And then in the middle between those two, that's my preference. And I hope they put them in the middle. You put the, yeah, they did. You put the gain or loss between how much you lost or gained. And also if you get some cash, you debit cash for that amount. Debiting cash would be the first thing you would do. On the first entry, we did get $33,000 worth of cash. So we would put that in first. Then we would go ahead and debit the accumulated depreciation for whatever amount the account had, the balance of the account. Then we would skip a line for the gain or loss because we don't know whether it's gain or loss quite yet. And then we would go to the last line, we would clear the equipment account. Okay, so now we look at it and see what do we need to balance this account. A gain or loss entry always is going to have, unless it's sold for its book value, which is very rare. It's possible, but it's not very likely. Then there's going to be a difference between the debits and credits when you get to this point. You've got the cash you received. You cleared your account, accumulated depreciation account by debiting it. You cleared your asset account by crediting it. So now you got to look at your debits and credits and see where the discrepancy is, because we all know that we have to have a balance. All the debit entries have to equal all the credit entries. So the debit entry total, if you look at it, is $50,615. And the credit entries are only $60,000. So we're like, oh no, I don't balance. I need 1,500 more in credits. So as soon as you see that you need a credit to balance it, that's telling you automatically that it is a gain, because gains and revenue are credit balances account. right? Losses and expenses are debit balance accounts. So we know already that we're going to have a gain on disposition for this $1,500. The other way you could have told that, of course, would just be to write the numbers down and say, here's my net book value. The asset cost 60,000 minus accumulated of 28. That would put me at 32,000. And that was my book value. And I got cash for it, 33.5. So obviously I got a 1,500 more than my net book value. That's my gain. And that's why I have to report the credit gain on disposal. All right. Now the B machine we scrapped, meaning there's not going to be a gain. There might be a loss if they didn't sell it for if it wasn't already fully depreciated, I should say. So what we're going to do is the same thing. There's no cash, but there would be accumulated depreciation that we have to clear. So we'll do that. We'll skip the line for the gain or loss. We're going to clear the equipment account because again, they're leaving. So we need their balances to go to zero. So looking at the entry, I see that I have a debit of 73.65. I have a credit of 14.2. I need another debit to make this account, this journal entry balance, don't I? $6,835 debit. So looking at that, the only thing I had to do since it's a scrapped asset is I'm missing, is it a gain or loss? So if I'm having to debit to get the journal entry to balance, is it a gain or is it a loss? A debit is equivalent to an expense from the standpoint of whether it's a debit or credit, right? So it is a loss because debits, because expenses and losses are both debit accounts, right? That's the normal balance for a loss. So that's all you have to do to get that. And then you could have just looked at it and said, okay, I sold this asset. It had a net book value of $6,835. I sold it for zero. So that obviously is a loss. So, or you could think the remaining net book value that's there gets written off as a loss whenever you dispose of it as a scrap. Okay, that's all for chapter 9.